Good morning, traders. Welcome to the week ahead preview with me, Aaron Hill, Head of Research here at FP Markets. Well, the only place to begin this morning is in the US, where unless you've been hiding under a rock the past few days, US President Donald Trump's reciprocal tariff announcement on the 2nd of April, an event he described as Liberation Day, witnessed risk assets hit the ropes last week as tariffs were more hard-hitting than expected. Global equities went into free fall and ended the week red across the board, with Asia seeing strong follow-through overnight today and plunging by the most since 2008. I've also just seen some news where the Hang Seng Index closed down. I'm just reading the notes here. Was down 13% in today's session. This is the largest one-day drop since 1997. Look, European cash markets have also opened in the red. As you can see, the Euro Stoxx 50. Look, it's a complete bloodbath at the minute. US equity index futures are also trading south. Look, quite literally, no asset class was spared last week, and it appears we could be in for another tumultuous week of trading. Now, the VIX, I mean, just wow. The VIX, one of the most popular measures of US stock market volatility, and since September of 2020, whenever we hit this resistance is between 37 and 35-ish. We tend to see the S&P 500 pull back. Given that we are now testing highs, we have tested highs of 40 on the VIX right now. I am looking at this support area on the daily time frame of the S&P 500 between 4,892 and 4,960. As you can see, it is simply a Fibonacci minus the 50% ratio there, a Fibonacci support zone made up of the 61.8% retracement ratio and the 1.272% Fibonacci projection ratio, which for anyone that follows harmonics may recognize this as a potential alternate AB equals CD support level. Now, US Treasuries were also heavily bid last week. As you can see on the benchmark 10-year yield, the US 10-year yield here, we have seen some would refer to this as a complex head and shoulders top pattern, given that we essentially have two right shoulders here. Regardless, we have broken the neckline that extended from the low of 4.13%. We have broken that strongly to the downside, with a profit objective as far south, with a potential profit objective as far south as 3.44%. Finally, on the US dollar, in the FX space, the US dollar closed down, I think, let me just check my notes here. It closed down 1.4% last week. And we shook hands, as you can see here, shook hands with levels not seen since late 2024. We did see a minor recovery to the upside. The US dollar did eventually benefit from safe haven flows, essentially towards the end of the week. You will note that we are now testing that 50-month simple moving average on the monthly time frame there at 101.97, alongside this daily support level at 101.92. Now, for anyone that follows my technical posts for the week ahead, you will note that last week the research team highlighted this combination, this 50-month simple moving average and this daily support, as a potential area we may see buyers step in from. As you can see, we have indeed seen this, but how much of a pullback will emerge from this level, given the current uncertainty in the markets right now, is very difficult to judge. Outside of this resistance at 103.95 and the current daily support here, I am looking at this resistance area above at between 105.77 and the 200-day simple moving average of 104.85. So between this area here, I do believe this is a reasonably well-placed resistance area to keep an eye on should we pop to the upside here. But look, follow through selling to the downside could see 101.92 breached and this support at 100.54 entering the fray here. Now in the commodity space, gold. Now spot gold explored lower levels from all-time highs of 3,167 last week, and this was down 1.5% on the week. Now, why is gold selling off, even though it is considered a safe haven asset? Now, this is a place where investors store their money in times of turmoil. And this is a question I've been asked a number of times now. I think it really all boils down to investors squaring off their exposure in the yellow metal to help balance portfolios. Now, technically, as you can see here on the monthly time frame, we did form a high just ahead of that resistance area between the 1.618% Fibonacci projection ratio and that 1.272% projection ratio at 3187. We also have the RSI deep within overbought territory and at a resistance of at a strong area of resistance on the RSI, and this is between, bear with me guys, between 87.31 and 82.80. Now, if we move across to the daily time frame, we can see that this decision point between 2,983 and 3,004 has entered the fray. Now, I think it was in the week ahead preview, that's just gone by. I did highlight this decision point as a potential area we may see buyers step in from. Now, I do believe that this has a bold question mark applied to it, this decision point here, purely because we've already reacted from this area back in late March of this year. Given that, and given this spike below the area, likely tripping sell stops, I do believe we are in for lower prices, technically speaking, and this level of support at 2,942 is an area I do believe buyers will look to defend, simply because of the strong uptrend we're in and this available liquidity just below this decision point, which did, in effect, build some trust from this reaction back in late March. Now, if we move across to WTI oil, I mean, what a move. What a move. I mean, last week we ended lower down nearly 10%. 10% on the week, and this breached the lower edge of this rather large descending triangle pattern. Now, I do feel that we are in for lower prices on WTI oil towards this weekly decision point at 51.38, 53.92. But if you skid across to the H1 timeframe, this is an area that really caught my eye. This is a bearish decision point, and this was actually where the decision was made, technically, to push lower, to push below that. This is the weekly, the lower boundary of that weekly descending triangle there. And this is between 64.90 and 64.24. So if we should see a pullback to the upside here and a test of this area, could really be an area that sellers draw to, given the precise entry and exit levels offered here, and the considerable risk to reward on offer here, especially if we do target that weekly decision point. As I said, 51.38, 53.92. So what now? Unquestionably, Trump's Liberation Day captivated a global audience. All nations, I'm sure you're all aware of this, but all nations were slapped with a 10% baseline tax on imported goods into the US, which has already taken effect. On top of this, higher than expected tariffs were imposed on approximately 60 other countries and are anticipated to go into effect on the 9th of April. And this was according to a White House fact sheet that I read. Look, as you can see here, the European Union was hit with a 20% levy. As of writing, aside from promises of countermeasures, the EU have yet to strike back. Now, a 34% tariff on China was imposed. And in addition to the 20% tariff already implied, this brings the total tariff rate for Chinese imports to 54%. Now, China, on the other hand, has already retaliated, imposing 34% tariffs on US imports. And this, I'm just checking my notes here, this is expected to kick in on the 10th of April. Unsurprisingly, to which Trump, via his his Truth Social network, responded by saying China played it wrong. They panicked. The one thing they cannot afford to do. Trump also imposed substantial tariffs, as you can see here. Trump also imposed a number of considerable tariffs on several Asia Pacific countries, with Cambodian goods attracting a 49% tariff, Vietnam 46% tariff, and Indonesia 32%, and Taiwan at 32%. I mean, these are considerable numbers. Understandably, look, recent events prompt several questions, such as what these tariffs mean for the US economy. Given that this is only likely the beginning of negotiations and potential countermeasures, and because of China's response, are we now facing a full-blown disruptive trade war? Uncertainty is clearly very high right now, which US, as you can see here, US Fed Chairman Jerome Powell really did stress on Friday. He stated that tariffs are set to weigh on economic growth and increase price pressures. Powell added, and I'm quoting here, "It is not clear at this time what the appropriate path for monetary policy will be," and stated that the Fed really needs to wait this out and see how it plays and see how things play out before making adjustments. Now, naturally, stagflation concerns really remain elevated. So lower growth could position for a dovish Fed, though at the same time we have increasing price pressures swinging the pendulum toward more of a hawkish Federal Reserve to help control inflation. Now, this is just my opinion here, and look, given the Fed's recent history with inflation, this will likely be their core focus going forward. In terms of, look, markets are now pricing in, I'm just checking here, markets are now pricing in 115 basis points worth of cuts by the year end, and as investors are expecting the Fed to help support the economy by lowering rates. And as you can see here, possibly beginning as soon as June's meeting, we currently have 42 basis points of worth of cuts priced in. Although somewhat overlooked, we also had the US employment situation report out for March on Friday. As I said, this was largely overlooked by the markets. It was overshadowed by all of the tariff uncertainty in play. Now, despite the federal layoffs, 220, as you can see here, 228,000 new jobs were added to the economy, and this comfortably surpassed the median estimate of 135,000. It also comfortably surpassed the maximum estimate of 185,000. So despite demonstrating US economic resilience and really further highlighting that divergence between hard and soft data, markets, as I've already said, were somewhat muted to the release. However, Trump welcomed the latest job numbers via his Truth Social platform, and I'm quoting here, guys, "Great job numbers, far better than expected. It's already working. Hang tough, we can't lose." Try telling that to the stock traders this morning. Anyway, so look, the US unemployment ticked higher to 4.2% against the median estimate of 4.1% and a prior of 4.1%. Now, wage growth remained unchanged at 0.3% in March, but on a year-over-year basis, we saw wage growth slightly soften to 3.8%. This is against the median estimate of 3.9% and the prior February's print of 4%. Now, so where to now? Well, Donald Trump is clearly not backing down. Recent news I read this morning, Trump has warned foreign governments that they would have to, and I quote, pay a lot of money to lift sweeping tariffs. Trump has also compared tariffs to, believe it or not, medicine. His remarks, this triggered further downside in markets following these comments. So really, the focus right now is on US growth concerns and tariffs. Another thing to keep in mind is where and when is the bottom. We just don't know right now, and hence the elevated uncertainty. And really, everyone is in the same boat. China's response, but what next? This is another question that most of us will be thinking. The future is clearly uncertain, and we are seeing this in the markets. Another thing to consider is much of the data will not be showing the impact, the tariff impact, until next month at the latest, which really does not help things from a policy perspective and also a trading perspective. In addition to the markets focusing on US tariff developments, particularly responses from the trading partners. The macro spotlight will be on the US CPI inflation data here on the 10th of March. That's a Thursday at 12:30 p.m. GMT. This is London time here, guys, 1:30. The minutes from the latest Fed meeting and also consumer sentiment data. Now, March's US CPI will be... It kind of takes a back seat given what's happening in right now with tariffs, but it's certainly still a key risk event to be aware of, particularly with risks of higher inflation amid tariffs and the possibility of further policy easing this year. Now, signs of elevated price pressures could see investors pare back their rate cut bets, which may weigh on US Treasury yields and the US dollar, while anything lower than expected could prompt the opposite outcome and underpin yields and the dollar. In terms of what economists are expecting, headline year over year, what the economists are expecting a 2-point headline inflation to ease to 2.6%, down from 2.8% in February. On the core front, we are expecting 3%. For March, down from 3.1%. So year over year, we are expecting inflation to pull back. On the headline front, month over month, we're looking at a 0.1% print. This is down from 0.2% in February. On the month over month core print, we are expecting a slight uptick to 0.3% from 0.2%. Now, the Fed meeting minutes on Wednesday will also be closely watched, I believe, and as this may provide more indication into both inflation expectations and whether forecasts of nearly 5 rate cuts now by the markets are realistic. You will recall that the Fed, in its last meeting, kept the target rate on hold in March at 4.25%, 4.5%, and highlighted an increase in economic uncertainty. Through the Fed's SEP, the Summary of Economic Projections, members also noted that they still expect only 2 rate cuts this year. Though it is important to note that more members lent towards leaving the Fed funds target rate on hold this year. As was expected, real GDP was revised lower this year, as well as in 2026 and 2027, with PCE inflation projections also revised upward for 2025 and 2026, and is expected to reach the Fed's inflation target by 2027. Now, on Friday, to wrap up the week, we also have consumer sentiment data for, I'm just trying to find it here, guys, bear with me. There we go. So we have consumer sentiment data for April from the University of Michigan. Now, this is 3 p.m. UK time, so 2 p.m. GMT. This will be an interesting print to monitor, I believe, given sentiment is already in the doldrums. However, although the sample set for this release is small, I believe it consists of 500 telephone interviews. And this, when you compare this to the 3,000 sample set in the US Conference Board survey, it's quite a difference. But one thing I do really want to highlight here is the interview dates for this week's preliminary print are between the 25th of March and the 7th of April, meaning that the tail end of this date range includes Trump's tariffs. As such, it could help provide some insight into how much tariffs have impacted sentiment. As you can see here, the median expectation is 54.7. This is down from the revised 57. The estimate range is between a high of 57 and 49. So look, guys, that's really it from me today. No doubt we with volatility this high and uncertainty also still extremely elevated, this remains a tricky market to trade. And look, although we can be long, although we can be short, although we can try and catch the bottom here or try and catch the top in some markets, sometimes being flat can be the better position. So position sizing is incredibly important at this time. Risk management strategies are also, just incredibly important at this time. I hope you took something away from this video, and as always, please like and subscribe to the channel for more videos like this. Thank you very much for listening, and have a great week.